You've probably seen the headlines. Google is suddenly back in the lead in the AI race. Its market cap has rebounded sharply, surpassing Microsoft and now trading close to Nvidia. At the same time, Microsoft lost $500 billion in market value in just a single week. Nvidia, meanwhile, has struggled to find direction for months. And then came another surprise. Apple chose Google's Gemini, not OpenAI, to power Siri. Just 1 or 2 years ago, Google looked like it was falling behind in AI. So has the board flipped? Did Google really stage a comeback? Or are we witnessing something deeper? A shift in how the market is pricing expectations. For a long time, the AI race looked like a 3-player game, and Google wasn't part of it. On one side, there was OpenAI, leading with ChatGPT. Behind it stood Microsoft, providing the capital. And above it all was Nvidia, supplying nearly all the chips that powered the AI boom. Open a news app, scroll through an investing forum. It was always the same 3 names. Investors reached the same conclusion. If AI was going to generate real profits, those profits would flow through these companies. Microsoft was expected to become the AI platform. Nvidia was seen as the essential infrastructure. Money moved quickly. Stock prices climbed sharply. And in the middle of that surge, Google slowly faded from the narrative. Even though it pioneered the transformer architecture, the market categorized it as the company playing catch-up. The winners of the AI boom seemed already decided, and those expectations began to show up in stock prices before the results ever did. In 2017, Google researchers published a paper titled, "Attention is All You Need." That paper introduced the transformer architecture, which later became the foundation of modern generative AI. As of 2024, it has been cited more than 170,000 times, making it one of the most referenced research papers of the 21st century. The technical foundation of generative AI began at Google. And yet, ironically, when AI moved from research to commercialization, Google was no longer at the center of the story. Out of the 8 co-authors of that paper, 7 eventually left Google. Several founded startups. One joined OpenAI. The technology existed, but the structure to aggressively push it forward was different. Innovation inside a large corporation prioritizes stability over speed, especially when the cost of failure can impact the entire brand. Google's revenue structure reinforced that caution. In 2023, 76% of Google's revenue came from advertising. That was more than $230 billion, directly tied to the credibility of search. If an AI model delivers incorrect information, the consequences go beyond a product error. Advertiser trust, user engagement, and the broader search ecosystem can all be affected. Google could not move like a startup. OpenAI, on the other hand, operated under different constraints. It could launch quickly, iterate publicly, and fix problems along the way. ChatGPT reached 100 million users at record speed. At that moment, AI was no longer seen as research. It was seen as a commercialization race. Microsoft was revalued as an AI platform company. Nvidia emerged as the core supplier of AI demand. Market expectations formed around those 2 companies. Google, meanwhile, launched Bard later. During its first demo, it presented incorrect information, and roughly $100 billion in market value disappeared in a single day. The issue wasn't just technical, it was about trust. The narrative hardened. Google was late. Then came the Gemini demo, which also struggled to impress. Clips of errors spread quickly. From 2023 through 2025, while the AI boom accelerated, Google's stock remained relatively flat. As other big tech companies surged, Google drifted away from the center of expectation. At that point, Google appeared to be falling behind in the AI race. Many declared it a loser. But while the market's attention was focused elsewhere, Google was quietly rebuilding the board in a very different direction. What people missed was that this wasn't just about launching another model. Google wasn't simply building another chatbot. It was positioning itself to control the entire AI supply chain. Gemini was only the visible layer. Behind it stood years of accumulated infrastructure. Custom-designed chips. TPUs, now in their 6th generation. Internal benchmarks suggested more than 4 times the performance per watt compared to Nvidia's H100. Dozens of hyperscale data centers, a global network backbone, and its own cloud platform. AI does not run on models alone. It requires chips. It requires power, cooling systems, massive data centers, and the software ecosystem that connects everything together. OpenAI depends on Nvidia's GPUs. Nvidia depends on TSMC. And TSMC operates within a highly concentrated global semiconductor supply chain exposed to geopolitical risk. The larger this system grows, the more fragile it becomes. Meanwhile, Microsoft was pouring enormous capital into AI infrastructure. $37 billion in capital expenditure in a single quarter, more than 60% higher than the year before. The question was simple. Was AI generating enough cash flow to justify that scale of investment? Spending was accelerating, but costs were beginning to outpace revenue growth. AI was slowly shifting from a growth story to a capital-intensive industry. Then, in early 2026, a single decision reshaped the narrative. Apple chose Gemini as the AI partner for Siri. Not ChatGPT, not Llama, not any other model. That decision carried meaning far beyond technical comparison. Siri serves hundreds of millions of users every single day. There is no room for experimentation at that scale. Apple didn't need the flashiest model. It needed the most stable partner. An AI supply chain exposed to bottlenecks was a risk. A partner burning through cash was also a risk. Google, by contrast, had built a vertically integrated AI stack. From models, to chips, to data centers, to cloud infrastructure, to monetization, through its advertising system. That structure is less sensitive to external supply shocks. When companies like Anthropic began renting large volumes of Google's TPUs, it signaled something more than collaboration. Google was becoming an AI infrastructure provider in its own right. At the same time, Gemini was being deployed through cloud APIs to enterprise customers. Google Cloud grew more than 35%. Its backlog surpassed $100 billion. These were not circular AI investments between tech companies. These were real enterprise contracts. AI was no longer in the experimental phase. It was entering enterprise adoption. And Google was positioning itself at the center of that transition. At this point, AI was no longer about who had the most innovative model. It was about who controlled the entire pipeline. And that structural shift began to challenge the market's original expectations. So, did Google win the AI race? On the surface, it might look that way. Its market cap has risen. Apple chose Gemini, and Google Cloud is growing quickly. But this shift looks less like a victory and more like a repricing. When the AI boom began, market expectations became highly concentrated. OpenAI symbolized innovation. Microsoft funded the expansion. Nvidia supplied the essential hardware. These 3 companies were seen as the center of AI, and that expectation was rapidly reflected in their stock prices. Perfect growth, unlimited demand, sustained excess returns. All of those assumptions were priced in, so even strong earnings failed to move valuations significantly. The expectations had already been embedded. Nvidia was trading as if flawless AI growth were guaranteed. Microsoft had already received a premium for AI leadership. As a result, additional positive news barely shifted their stock prices. Google was different. From 2021 to 2024, its stock moved mostly sideways. During the AI surge, Google was perceived as the company playing catch-up. Expectations were low, and low expectations were reflected in the price. But the nature of AI began to change. What looked like a model race became a capital race. The question was no longer who launched first, but who could sustain the infrastructure. AI requires enormous amounts of power, chips, data centers, and network capacity. As that structure became clearer, the criteria for valuation shifted. Does the company generate profit? Can it maintain cash flow? Can it control its supply chain? Under that framework, Google was recalculated. Despite investing $53 billion in AI, it maintained operating margins above 30%. Cloud revenue grew 35%. Its contract backlog exceeded $100 billion. AI began to look less like a cost center and more like a revenue engine. The market stopped asking who was first. It started asking who was structurally positioned to endure. And in that moment, expectations began to adjust. Google didn't suddenly become stronger. Its competitors didn't suddenly collapse. Expectations were simply redistributed. Nvidia had already priced in a near-perfect future. Microsoft now needed to demonstrate returns on massive capital spending. OpenAI faces a high burn rate and a fragile supply chain. The AI industry is moving from excitement to reality. In that transition, Google experienced the most dramatic shift in perception. It may look like a comeback story, but in many ways, it is closer to a normalization story. From discounted expectations back to structural relevance. The AI race is far from over. If anything, it may just be beginning. But one thing is becoming clear. AI is no longer a startup speed game. It is an infrastructure game. And infrastructure games tend to favor incumbents with scale, capital, and control. It may be too early to declare Google the winner, but the market is recalculating. The real question now is this: where will expectations become excessive next? And when they do, how will they be priced?